Alright, let's talk about something that sounds boring but actually controls almost everything in the markets: interest rates. If you're new to finance, you've probably heard stuff like, the Fed raised rates, and everyone on the news freaks out. So, what's the big deal? Why do stock prices, crypto, even housing seem to go wild when interest rates change? Here's the deal. Interest rates are basically the cost of borrowing money. When rates go up, it's more expensive to take out loans, whether you're a giant company or just buying your first car. When rates are low, money is cheap, and people borrow more. Sounds simple, right? But this small change actually sends shockwaves through the whole economy. Let's start with the stock market. Stocks love low interest rates. Why? Because companies can borrow money for less, invest in new projects, expand, and hopefully make more profit. Investors see that and get excited, so stock prices usually go up. But when rates climb, borrowing gets pricey. Companies might pull back on spending, growth slows, and investors get nervous, so stocks can drop. Now, what about crypto? It's a bit different, but it still feels the heat. Crypto's often seen as a risky, high-reward investment. When interest rates are super low, people are more willing to take risks. They're chasing better returns than what they get in a boring savings account. But if rates rise, suddenly those safe investments like bonds become more attractive. Some folks pull their money out of crypto and plop it into things like government bonds. That can drag crypto prices down. Other markets, think real estate, bonds, even collectibles, get hit too. Take real estate, higher rates mean bigger mortgage payments. That can cool off a red-hot housing market in a hurry. Bonds are even more sensitive. When new bonds pay higher interest, existing bonds with lower rates lose value. But it's not all doom and gloom. Sometimes raising rates is exactly what the economy needs. If prices, also called inflation, are rising too fast, higher rates help slow things down. People spend less, demand drops, and prices eventually stabilize. On the flip side, if the economy's weak, cutting rates makes borrowing easier, spending picks up, and things can bounce back. So, next time you hear about the Fed raising or lowering rates, remember, it isn't just some boring number. It's a signal that affects your investments, your loans, even your future paychecks. Understanding interest rates gives you a superpower in the financial world. You'll see the reasons behind those wild market swings. And you might even spot opportunities others miss. If you found this useful, hit save or share with a friend who needs to hear this. Finance doesn't have to be a mystery. Stick with me, and I'll break down more money secrets so you can take control of your future.